One renowned retirement expert and former Goldman Sachs banker is stepping forward and revealing his number one way to beat inflation. It's a way to receive a nearly 10% yield from the government with virtually no risk. Folks who take the three simple steps he's sharing right now could receive nearly $1,500 from the US Treasury in as little as a few months. Best of all, it's guaranteed by law, and you could pay zero taxes on this low risk investment. Consider how rapidly inflation continues to soar. You don't want to waste any time missing out on the potential profits he believes are in store for this investment. To get a copy of his new free report with all the details, simply go to beatinflationreport.com. Again, that's beatinflationreport.com for a free copy of his new report. Welcome to Making Money. This is Matt McCall. Thanks for joining me. First of all, happy 4th. Hope everybody had a great Independence Day, had fun, stayed safe, and enjoyed family and friends. I know I did. On today's show, we got a big show coming up. We're going to take a look back. We already did, but we're going to take even a deeper dive back at the last 6 months, the first 6 months of the year, and how that's setting up for the second half of the year. And then income investing. I know it's not something I talk about a lot, but it's actually on the cover of Barron's, even though I had this plan last week. Talk about income investing. I'm going to name 5 names you want to put on your watch list. All that coming up right now on Making Money. Again, welcome to Making Money. It's the 5th of July, 2022. Hope everybody had a wonderful 4th of July. Here down in Delray Beach, a great fireworks display on the beach. You can't really go wrong. Beautiful weather. A lot of families and kids out there having fun. So hope everybody else was able to enjoy something very similar as well. Celebrating what I still think is the greatest country in the world. So on today's show, we're going to talk about the markets, kind of looking back in the last 6 months. I know I've done that in the past, but we want to dive into a little bit more, just a few things, how it really sets up for the second half, because I say this all the time, and some people disagree with me, which I find absolutely crazy sometimes. I say you can't drive a car looking in the rearview mirror. And people tend to argue with me on Twitter and on YouTube when I say these things. I want to meet the person who drives a car looking in the rearview mirror. Sure, you glance at it, but you don't drive that way. You can't look in the past. It's crazy. So, I think people just say things to argue and be combative with people. So I tend to ignore it, but I don't want to be in a row with those drivers. We're going to do that. And then, as I mentioned, we're going to talk about income investing. There's a lot going on in the bond market right now. The Fed's still expected to continue to raise interest rates. What does that mean for people that are looking to get some yield coming in right now? We'll talk about that. So first, let me take a look here at the market, the S&P 500 here this morning. It's about 11:43 or so East Coast time here on Tuesday. So we've been open a little over 2 hours. We have the S&P down right now about 1.7%. We have the NASDAQ down, not as much, believe it or not, only down 0.6%. And then the Dow, believe it or not, is the one that's been taking the hit here today. The Dow's down over 2.2%, down nearly 700 points here this morning. So some of the bigger, more conservative, if you will, names are taking a hit. What I find extremely interesting is, look at this, folks. This is the ARK Innovation ETF, ARKK, which is Cathie Wood. People love to hate her. Innovation's dead, according to the bozos out there. But while the Dow is down over 2%, ARK fund, the aggressive one, is up nearly 4% today. So something weird going on here in the market. And I'm not going to try to be, looking through some crystal ball and tell you exactly what this means. It's one day. So one day does not make a market. However, that action is definitely very, very interesting and something I need to keep my eye on, because is this telling us that we've gotten to the point where the second quarter is done, the first half of the year is behind us, the NASDAQ and the innovation stocks got hit harder than anything else out there? Is it now time to get in there? And is money coming out of the Dow stocks, the bigger stocks, and going into some of these innovations? It's something I need to look into. I don't know exactly what it means here yet. So let me just give you a bit of a recap of kind of what got us here in 2022, this wacky time that we're living in. This was the worst start of the year since 1970, and the S&P was down 20.6% in the first 6 months. And to kind of give you an idea of how we really got to such a bad number, The last couple of months have been really bad. The last quarter was a true struggle. And we've been down 10 of the last 12 weeks. I mean, if that's not oversold in the near term, I don't know what is. Could we be down 14 of 16? Yes, we could. I'm not saying that, but you get to a point where just get exhausted on downside and buyers come in. That's might be what we're seeing right now in some of the innovation stocks. The Dow had its worst start since 1962 when it was down 15%. Go back to 1930 for the Dow. This is there's been 9 times that it's been down at least 10% in the first 6 months of the year. 6 of those 9, it was up in the next 6 months, and by an average of 8%. So again, you got about a 2 in 3 chance based on history, and the average gain is 8%, which is for 6 months annualized out is very, very good, much better than the average market. The Russell 2000, the small mid cap index, and the NASDAQ, which I just mentioned before, both had off to their worst start ever. Those indexes haven't been around as long, but their worst start ever. The NASDAQ lost 29%. So the other 8 times, this happened 8 times for the NASDAQ that it lost at least 10% in the first half. The average return over the next 6 months was, this is a bit of a monkey wrench here. The average return in the next 6 months in those 8 instances was a loss of 5.8% for the NASDAQ. So when the NASDAQ gets hit in the first half of the year, history shows that it continues to go lower. The second worst year was in 2002. So that was right after the tech bubble. It lost 25% in the first half and 8.7% in the second half. And the reason I'm telling you this, 8.7 still hurts. Trust me, that's still more downside from where we're already down now, 29% on the NASDAQ. But the one thing that I do think in my mind is if I look at the market right now, and again, I'm not looking in a rear view mirror, I'm just looking right now. If I was given $100,000 cash right now, what would I do with it? And I would start legging into the market, maybe 25% this week, maybe 25% in 2 weeks, and keep doing that, and just pick days. Every 2 weeks, another 25% until the 100 grand is in there. That's likely what I would do because 8.7% after such a really bad 2002, we ended up bottoming out then in 2002 and had a rally for several years up until 2008. Obviously, as we know, the great financial crisis stopped that. But if there's only, and again, this is just a number from last time, but if there's only 8.7% more on downside, I'll take that. That gives me limited downside with much higher upside. So the way I'm viewing it here is we have much higher upside than downside. So your reward to risk ratio is in your favor right now for the overall market and for a lot of individual stocks. Also this year so far, the IPOs, initial public offerings, new stocks coming out, slowest rate since 2009. We know 2009 was coming out of the great financial crisis. Every sector in the S&P 500 was down in the first half of the year except for energy. So if you look at your portfolio and you're down, it's okay because every sector but energy was down. Bonds, believe it or not, I can't remember what research firm it was, but they went back to the 18th century with comparable bonds for this country. The 18th century. The worst start for bonds since the 18th century. So again, you can't beat yourself up too much because we're in unprecedented times right now. The first 6 months is how bad things have been. And I got to tell you, folks, I'm in the market too, obviously. This is my passion. I love it. I constantly working on the market and my own portfolio as well and for subscribers. And in the past for my clients when I had a money management firm. And it does feel some days like nothing's working. It is tough. And these times are times I've lived through several times in the past. I started as a stockbroker in 2000 at Charles Schwab in Denver, Colorado. And I worked my way around from there. But I lived through the 2008, 2009, obviously the pandemic, and I'm going to probably live through many, many more bear markets and recessions in the future. So every time it feels very similar. It feels like nothing's working. Like you want to throw your hands up and give up. And I'm human too. I feel that I try to tamper down my emotions only because I know they get in my way and I make bad decisions. But I feel you is what I'm saying. I feel the same thing. And you have to remember that during a bear market, there's only really one true bottom down there, like one bottom. Like you may have literally little bottoms, but there's only one real bottom. And when that day hits, it doesn't feel like a bottom at that time. When that day hits, that bottom's in, you don't know till later, obviously. But that day, if you teleport yourself back, it doesn't feel like it. And I know a day, and this was in March of 2009, and there's video of it on YouTube out there right now. Um, I was on Fox Business, and I put out a portfolio, which many of you heard about, the Andrew Jackson portfolio. And that was actually the day that the S&P hit 666, the intraday low of that pullback. So that's been the lowest level since then. So I remember my mindset that day. I remember sitting down at the news desk and doing this, and I thought it was a great buying opportunity. And I was lucky and right, but I thought it was a great buying opportunity. But that day was scary because it felt like the market was never going to end. And they remember like the two hosts. It was I think it was Chris Cotter and Tracy Burns, or no, it wasn't. It was Sandra Smith, um, laughing at me off air, and not in a mean way, but laughing, saying, "Matt, you're crazy. Like this market's never going to stop going down." So I do remember that feeling that I had that day, and it feels like it's not going to end. So looking back, yeah, I sound smart and feel like a genius, but that day I didn't. Trust me, I will tell you that. And the last thing I want to say is, everybody's talking about recession. Are we going to go into one or are we not? I don't know. And if we do, I think it's going to be a shallow recession. I know that's kind of a buzzword right now, but I do truly believe it's going to be a shallow recession. So it is weird to have such a big pullback of 29% in the NASDAQ and not quite yet have a recession. So to me, I've been saying this for a while. We're pricing in a lot of stuff. The market looks ahead, and the market's pricing in this potential recession, these higher interest rates, the inflation. We know those are out there. So it's priced it in. So if a recession does happen, it doesn't matter because, again, you're typically looking back at a recession. Look back the last 3 months to let you know. Again, we need to look forward. So just keep that in mind. That's just kind of where we stand with the market here right now. I just want to kind of give you, a little bit of a history lesson on that, if you will. Now let's talk income investing. And what I want to pull up here first is a chart of the 10-year bond. And this is the yield on a 10-year. Right now it's at 2.79%, which, as you can see here, has pulled back quite a bit, folks. It was up around almost 3.45 just 2 weeks ago. So that's a massive pullback in yields. And remember, as yields go down, bonds go up and vice versa. So this has led to a rally in bonds as people are really kind of just freaking out, in my opinion. They're getting so concerned about a recession and what's going on in the world that they're running into bonds and locking that in. And as more people buy bonds prices go up and yields come down. And that's what we're seeing happening right now. So let me give you a chart here of TLT, which is a long bond ETF. You can see how much it's rallied. It's up about 8% in 2 weeks, which is a big, big move. But it's still in a very deep downtrend. I'm not saying you run out and get this anytime soon. Still in a very, very deep downtrend. But you're seeing that kind of bounce back. So we have the 10-year around, let's call it 2.8%. And it was funny because I love Barron's. I read Barron's every week. And I pull up my phone in the morning and there it is, Barron's. And it's like income investing. And I already had the show planned. I already had it typed up. So I thought it was kind of neat. And I want to talk about that too. So, as I mentioned, the worst start in literally centuries for bonds. So everybody's starting to give up on bonds. And I'm not a huge fixed income guy, but I think there's a place for it in your portfolio, of course. And I personally, which I'm not going to get to in this show, and maybe I will mention some in a couple of weeks, but I prefer to go out and buy an actual bond from the company. So say it's IBM, just making this up. IBM has a bond and it's paying yield to maturity of 3.5%. You're locked in at that 3.5%. You get your payments twice a year until maturity, then you get your money back. So that to me is much safer than a bond fund or a bond ETF because by doing that, even though you're not diversified, by doing that, you're betting on IBM. As long as IBM keeps making its bond payments, you're fine. It doesn't matter what else is going on in the world. It doesn't matter about interest rates. You get your fixed amount and you get your par back, your initial investment back when the bond matures. I like doing that and building what they call a bond ladder with a bunch of different ones. Little aggressive for a show like this, but that's what I like to do. But for normal people, you can look to bond ETFs and bond funds. One area that I'm finding pretty tough to ignore right now, and I'll show you this chart, and it's ugly as heck, but it's the municipal bonds. And here's a chart of HYD. This is the VanEck High Yield Municipal Bond ETF. And I used to own this way back in the day, 2008, 8, 9-ish. at the market bottom, I bought a lot of this for clients because the yield was very nice, and it was one of our really big winners for a municipal, because people back then, with interest rates so low, were looking for an alternative to gain some type of interest versus a checking account, which you still can't really get anything in a checking account or savings account. And I turned a lot of clients onto this, and that being one of my best, not as far as return, but one of my best investments, I think, that I shared with clients over 17 years, because it really, I mean, the amount of money that was made off this versus sitting in a bank account getting zero at the time was a huge game changer for a lot of people. So HYD is pretty interesting. You see the chart here is ugly, but let me show you a little bit longer term chart and give you an idea. You see back here, 08 and 09, I think we were buying back around here. It hasn't done much. But you can see these lower levels here, it tends to bounce back from them. So from there to get back up there, that's about, you're looking at what, $10 or so. So maybe, 20%. But the kicker is this. It's not about that. It's about the yield. And the yield on HYD right now, the 30-day SEC yield is 4.28%, which I just told you 10 years, 2.8. So that's good. However, you put this in a taxable account and it's tax-free. So if you're a high income earner, say you fall into the 37% federal tax bracket, the equivalent taxable yield for this, because you're not paying taxes on the income, 6.8%. That's fantastic. That's something where I don't care if it goes sideways. If that's the portion I'm looking for, 6.8%, I'll take it. And it's a big fund. It's about $3.1 billion in assets under management. And a lot of it is what they call junk, high yield. But 25% is in triple B, which is the higher level of the high yield junk portion of it, because they're a little more liquid. So they always keep 25% in triple B for liquidity. That being said, there's over 1,700 holdings, and only one holding makes up more than 0.88%. So it is a very diversified ETF. California is the largest concentration at 13%, Illinois at 12%, New York at 9%, Jersey at 7%, Florida at 6%. So a lot of the big states, obviously, in there. But this is something where, again, I think if you're looking for something in a taxable account, it doesn't make sense to put it in a tax-deferred account because you're not paying taxes on this stuff. And of course, always check with your accountant, make sure it works for you. And again, nothing here is a buy or sell recommendation. But I think this is something you want to throw on the list, and it's always often overlooked. And when it comes to municipals, they are nicely valued right now versus government bonds and some corporate bonds. And I really got to tell you, I don't see municipalities having any trouble right now, not like they were 10 years ago. So I think this is one you want to throw on the list. Another one in a very completely different area. And again, I want to tell you, the stocks that are income producers are getting crushed today. Again, innovation up, these are going down. This stock's getting hit, but I still like it. This is Vistra, symbols VST. It's listed as a utility company, but it has a lot of exposure to solar and renewable energy, which I like. Pulling back from a high, down big today, down over 8% today, as you're seeing, again, all these income get hit. Again, not buy or sell recommendations, but things I think you should put on your watch list. It's a $10 billion company. It's got a 3% dividend. Its PE ratio going forward, 7.4. Its price to sales is 0.66. Price to book, 1.9. So it's very nicely valued. I mean, typically, the utilities are, but this is a really nice looking fundamental rap sheet that it's got here in front of it. So it does electricity generation. It does some wholesale purchases and sales of energy. They just announced about a month ago on June 7th that their Emerald Grove solar facility in Texas, it's the third of their 7 renewable and energy storage projects that they have right now is launched. And they're all going to be in Texas, these 7 projects. So they're really moving towards what they believe is going to be a zero carbon power generation company, that they're going to really move all to renewable. And so I think that's why I like this. It's exposure to renewables, both solar and wind, is really like Vistra. And again, you get the 3% dividend kick coming with it as well. The next one is in the energy space. This is Kinder Morgan, symbol KMI. And Kinder Morgan is about a $38.5 billion company. It's one of the largest midstream energy firms. So it's the pipelines. And dividend of this one is 6.54%. And we can take a look at the chart here. And as you can see, it's just kind of been up and down. Look at a longer term chart and give you an idea. Doesn't really move too much. It's actually held up pretty well over the years, considering oil's really come down until recently. but it's had a big sell-off as of late. I like this because it's got a heavier concentration on the pipeline business for natural gas versus crude. And they're really starting to pump a lot of natural gas, and we're getting into LNG facilities. And as LNG, liquefied natural gas, takes off, the demand for the more natural gas pipelines will increase. So that's why I like Kinder Morgan, and you can throw that little 6.5% kicker dividend into it as well. But this is one I want to keep an eye on. All right, so the next one we're going to take a look at here is two more, and these both have to do with farmland. And we were having a discussion yesterday at a little barbecue, and one of the guys there was a VC guy, and everybody always asks me about stocks. I guess if you're a doctor, they ask you doctor questions. I don't know. I get stock and money questions 24/7. And I like it because I love what I do, but you get some off the wall questions. But we were talking yesterday about um, different types of real estate. And I said the one area that I love and I wish I had gotten into earlier, and I still might get into it, is farmland. And did you know that the largest independent farmland owner in America is Bill Gates? Used to be Ted Turner back in the day. He might be the largest landowner, but Bill Gates is the largest owner of farmland in the country. So that should say something. Not that I'm a big Bill Gates fan. I think he's cuckoo, but it just tells you, smart people put money there. And a lot of very rich people own a lot of farmland. So two stocks I want to show you here. One is Gladstone. The symbol is land, LAND. So it's pretty easy to remember. So Gladstone Land Corp, you can see here in the chart, had a big run up from November through April, and then a big sell off here. And if we zoom out a little bit further, what we can see is the stock did nothing for years and just started taking off in 2020 after the pandemic, and really took off up 4x, and then it's now come back and cut itself in half. I like the pullback that we see here in the chart. I like personally farmland, and there's only really two publicly traded companies that give you direct exposure to it. Gladstone, at the end of the first quarter, so just at the end of March of this year, owned 164 farms, over 113,000 acres in 15 different states. They owned 45,000 acre feet of banked water as well in California. I like that. So overall, they own about $1.5 billion in farmland. The company is valued at $735 million. Has a dividend ratio of 2.44%. So not extremely high, but you get a little kicker there in the end. But I wanted to talk about the farmland because I think it kind of fits in with the income producing kind of safer areas that a lot of people are looking for right now. And the other one that is in this space is Farmland Partners. That symbol is FPI. As you see in the chart, this one's actually held up a little bit better. It hasn't pulled back as much. If I show you the long-term chart, very similar, kind of took off here in 2020, down from around $5 a share up to 16, pulling back a little bit. This has a nicer looking chart. Now, that doesn't mean everything, but it has a nicer looking chart, I will tell you that. So Farmland Partners, $670 million company, so it's slightly smaller than Gladstone Land. They own or manage 185,000 acres. So a little bit bigger farmland. They're in 19 states, and that's at the end of the first quarter as well. Over 100 tenants there. They produce 26 crop types on their farms. About 70% of its portfolio by value were farms that grow commodities such as corn, soybeans, wheat, rice, which they've pulled back recently, but a big demand from that, what's going on in Ukraine. The other 30% do more specialty crops, citrus and fruits and stuff like that. They also are starting to work with some renewable energy companies, and they're turning some of the land into solar and wind farms. So you have that going for it. They now have 5 solar projects on 5 different farms right now. And they have a dividend. It's not nearly as big as a lot of these others, 1.75%. But again, a little kicker you get on it. But these two, the last two, both Gladstone Land and Farmland Partners, to me are more about exposure to farmland. And kind of really diversifying your portfolio with a little dividend that comes with it. So again, just to kind of wrap up what I'm looking at here, and again, nothing's here a buy or sell recommendation, but when it comes to income investing, people might think, well, Matt doesn't do that. I do everything. I just think the greatest opportunity for the roaring 2020s is in innovation right now, especially the pullback that we've had. But it doesn't mean you shouldn't have a diversified portfolio, folks. Have some income producing in there. You have some exposure to farmland. You can have some commodities if you want. No gold. I think gold's still dead, and I will still keep saying that and I'll change my tune if I'm wrong. But I want to show you something as we wrap up the show here. Here's a chart of gold, and people keep bashing me like I'm an idiot, and maybe I am an idiot, but that's irrelevant. Gold is now about to have its worst close since October. We've had inflation booming. How is this an inflation hedge? I saw somebody on one of my colleagues' show the other day, and the headline was "Gold: How Amazing Gold Has Been Doing." What the hell are they looking at? Gold has been a dog. And then the argument back is, well, Matt, Bitcoin stinks. Bitcoin has sucked too. But it's not Bitcoin versus gold. It's gold versus gold. And gold has not worked. I don't care what you all say. That chart I just showed you speaks. Maybe if I turn my computer upside down, all the gold bugs will actually be happy, but it's not working. So I don't get it. I don't understand it. And I'm not a hater. If gold gets to a level that I think is attractive, if the setup for gold is something that I think will be profitable for me and my subscribers, then I will recommend it. I just don't see that right now. So because I don't like it, don't get mad at me. Because you guys don't like a lot of my stocks, and I don't take it personal. I could care less. That's more for me. So it's more gold for you. I'm not buying any. So it's more for you. So anyway, folks, I'm going to wrap it up there. We have the S&P right now, right around noon here, East Coast time, down about 1.6%, near the highs of the day, believe it or not. And the ARK fund continues to rock and roll, now up 4.3% on the day. I got to dive into this more. If this trend continues, we'll talk about it. And coming up on Thursday, we have a nice interview lined up with a great guest. He's got a ton of followers, over 500,000 followers on Twitter. So we're going to start trying to bring in guests every week if we can, and doing a show for that. So thank you so much for watching. Hope you had a great 4th. Hope you're not too hungover today. Hope you had a great morning, great night, and we'll be back Thursday. Stay safe, be happy, and remember, the market's going to be there when you wake up tomorrow. Thank you so much for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.